Hi everyone, I'm Stephen Gage, President of Vision Commercial Development. Today we're going to dive into how real estate developers make money, from property acquisition to creative financing, construction management, and beyond. There are many ways which real estate developers maximize profit throughout a project's life cycle, and we'll break down each strategy step by step. So let's get started. Every profitable development project begins with property acquisition. Developers seek out land or properties with strong growth potential, often looking at factors like location, zoning, and future development plans. By purchasing properties below their future market value, developers build in potential profit right from the start. Think of it this way. If I buy a property with high growth potential, the difference between the acquisition cost and its future value is profit that can be realized even before construction begins. Before breaking ground, my team and I conduct extensive market research and feasibility studies to evaluate demand, potential competition, and any associated risks. This research phase is crucial. It helps inform us the overall project strategy and helps ensure that the development aligns with market needs. Developers often charge fees for these studies, especially when working with partners. These fees will cover the time, resources, and expertise needed to assess a project's viability, adding another revenue stream before construction even begins. Next comes financing. Developers typically secure funding through various means, including bank loans, private investors, or partnerships. By arranging and managing these financial arrangements, they may charge fees like loan origination fees or a percentage of equity investments. This is common in other industries too. For instance, if you are raising money for a company and someone goes out and sources investors for you. If you bring in someone to find private investors, that person sourcing a check might earn a percentage of the capital raised as compensation. These financing fees provide income before the project has generated any direct profits and help developers maximize their returns while reducing the amount of their own capital that they have invested. During the development and construction phase, developers oversee every aspect from planning and design to managing construction timelines and budgets. Developers often earn a profit margin on the construction costs or a developer's fee. This fee compensates them for managing the construction process and can vary depending on project complexity. Skilled developers maximize these profits by keeping costs down and timelines efficient, which enhances the project's overall profitability. One powerful strategy developers use to increase property's value is forced appreciation. This involves actively making improvements to increase the property's income potential. There are two main ways developers do this. The first one is increasing income. Developers can bring in new tenants at higher rents, renew leases at updated rates, or enhance the property to attract premium tenants. The second way is reducing expenses. For example, developers may upgrade to more efficient lighting, improve building insulation, or renegotiate contracts with vendors in order to lower their operating costs. Lowering expenses directly boosts the property's net operating income, which therefore increases its value. Developers have multiple ways to monetize their projects. The two primary strategies are property sales and rental income. With property sales, many developers generate significant income by selling completed properties, including residential units, commercial spaces, or entire developments. The profit here is the difference between the total sales revenue and the project's total cost. For rental income, some developers retain ownership to generate ongoing rental income, particularly with commercial properties. This strategy provides steady cash flow and allows for developers to benefit from long-term appreciation. By combining these strategies or choosing the right one for each project, developers can optimize returns and achieve steady cash flow or one-time profit windfalls. Beyond sales and rent, developers look for ancillary revenue streams to maximize their profits. This involves creating additional income sources on the property. For example, parking fees. Some developers may charge for parking spaces in commercial or mixed-use properties. Another stream of revenue may be on-site services like vending machines, laundry facilities, and storage units that all add up to extra cash flow with minimal upkeep. These additional income sources can significantly boost profitability, transforming unused spaces into revenue-generating assets that support the project's bottom line. Another way developers make money is that they enter into joint ventures and partnerships with other investors or developers, creating profit-sharing arrangements. By pooling resources and expertise, developers can tackle larger projects while sharing both the profits and the risks. This approach is beneficial in complex projects where the combined knowledge and capital of each partner can increase the likelihood of success. In cases where developers retain ownership, they can generate additional revenue through property management fees. These fees cover tasks like rent collection, maintenance, and tenant administration, providing steady income on top of rental cash flow. By managing properties effectively, developers can improve tenant satisfaction and reduce turnover, further increasing the value of that property. Property management allows for developers to maintain control over their assets while earning a steady income from overseeing daily operations. Real estate naturally tends to appreciate over time, so property appreciation contributes to a developer's wealth. By holding properties for extended periods, developers benefit from rising values, allowing them to cash in at higher rates down the line. Additionally, developers take advantage of tax benefits and incentives. Deductions such as depreciation can reduce tax liabilities, and programs like Opportunity Zones provide further tax incentives for development in specific areas. These advantages help increase net income and boost overall profitability. Last but not least, let's talk about profit margins. While profit can vary widely based on factors like property type, location, and market conditions, developers typically aim for returns in the range of 5 to 20% of the project's total cost. By optimizing each phase, from acquisition to financing, construction, and final sale, developers work to secure profits within this range, or sometimes even higher in strong markets. And there you have it, how real estate developers generate profit. From smart property acquisition and development fees to rental income, partnerships, and even tax benefits, successful developers use a combination of strategies to maximize their returns. Real estate development is all about balancing multiple income streams and adapting to market conditions to achieve long-term success. Thank you all for watching. If you enjoyed this video, please like, subscribe, and let me know in the comments. And if you're interested in commercial real estate investing and don't want to do it alone, our company, Vision Commercial Development, is always on the lookout for new investors who'd like to participate in groundbreaking projects. If you want to start working with the team today, head over to visioncommercialdevelopment.com and let's chat about new and fun investment opportunities that we could potentially work on together. Let me know in the comments what profit aspect of real estate development interests you the most. Thank you all again for watching, and we'll see you next time.